So let's continue and with chapter 1. Now let's look at the concept of the time value of money, of cash flows, the present value and the future value of money. Money loses value with time. This tells you that money today is worth more in value than money in the future. So money needs to grow. Investments need to grow every year. So if I say I have $2,000 today and I have $2,100 in 20 years, that doesn't mean I have more money in 20 years. I don't. Because money loses a lot of its value every year. In this qualification, before we get into calculating net present value and IRR and all of these calculations, you need to very much understand the very concept of present value today and future value later, sometimes called terminal value. TV or FV, future value or terminal value, you can find any one of these in the exam, so we'll use both of them interchangeably. So future value of money, think of deposit. The future value of money, or the terminal value of money, is equals to the present value, what you deposit today, assuming, for example, you deposit $100, and that $100 is going to grow by, let's say, 5% for the next 3 years. So $100 is the money I have today, the present value of that, and it's going to be growing at 5% for the next 3 years. We use what we call the compounding factor. Present value times 1 plus the rate at which we are growing to the power n, the number of periods. So the future value of this deposit will be equal to the present value of the money today is $100 times 1 plus the growth rate, which is 5%. Please remember to convert the percentage to a decimal. It's very important, because if you put 1 plus 5, you'll get the wrong answer. It should be 5%. Of course, 5% is 5 divided by 100, right? And this will give you 0.05. To the power n, number of periods, that's 3. So if we do this calculation, this should tell us that 105 to the power 3, 1.05 to the power 3 times 100, that should give you 115.76. So $100 today is equal to $115 after growth, $115 in the future. Why? Because we multiplied the present value with what we call the growth rate, which is, in this case, is 1.1576. So the $100 have grown 1.1576 times in these 3 years to become 115.76. Watch out in the exam. I doubt CISI would much bring it, but watch out in the exam if you're told that a certain investment, because here you're assumed that you are going to be getting the 5% every year. So 5%, 5%, 5%, 5% once a year. 5%, 5%, 5%. Sometimes certain investments give you 5% per annum, but they distribute it twice a year. For example, like bonds or some investments, they actually pay you twice a year. You still get 5% every year, but you get it twice. So 2.5%, 2.5%. So if that's the case, if this is an investment which you start with $100 and it will grow by 5%, remember, interest rates and yields, if we get into yields, always annual. Always annual. they're always quoted annual. So if CISI gives you this, grows 5%, the interest rate, assume that this is 5% per annum automatically. It's a convention in finance that interest rates and yields are quoted annually. Grows 5%, paid twice a year for 3 years. So what's the difference between this one at the top and this one at the bottom? This one and this one. $100 will grow 5% for 3 years. And this one 5% per annum. And this one $100 will grow 5% paid twice a year for 3 years. This doesn't mean that you are going to get paid 5% twice a year. No. If we say 5% paid twice a year, it means 5% per annum, even if CISI doesn't mention it in the exam. This is per annum. Paid twice a year. That means technically you're going to be getting 2.5% twice a year. So what you will be getting here is 2.5%. 2.5%, that's for the first year, because it's 5% per annum to pay twice a year. This is for year one. Again, this is for year two, 2.5, 2.5. And remember, this is a 3-year investment, 2.5 and 2.5. So implementing this concept in our formula, the future value of this investment will become $100 in the same way, because the present value is still $100, plus 1 plus, at which rate is our money growing? It's no longer growing at 5% 3 times. It is now growing at 2.5%, and it's growing 6 times. 1, 2, 3, 4, 5, 6. So if we do this calculation, 1.025 to the power 6 times 100. So we'll end up getting 115.97. So you notice that we end up getting a bigger amount. Of course, if this is in millions, you're going to get additional hundreds of thousands of dollars. Even though technically I am still getting 5% per annum, nothing has changed. What has changed is how further this is being compounded. If CISI tells you this is actually paid quarterly, so technically you're going to be getting 1.25% every quarter, plus 1.25%, plus 1.25%, plus 1.25%. That's in the first year. Do that across 3 years, you'll end up getting even a higher amount, probably somewhere around 116.1, around that. So the further money is compounded, the more you're going to earn. Even if the present value is the same and the annual rate is the same, if that is broken down in further, you're going to be compounded at a higher rate and you're going to be earning more. Now that we have put this concept aside, let's go back to the very formula of the future value equals to the present value times the growth rate. The rate at which this money present value is growing. Of course, the growth rate is 1 plus the rate to the power number of periods. If we do cross multiplication, if we need to calculate the present value, we just do cross multiplication. It's the future value over the growth rate. Because why? Because the future value in cross multiplication, the future value will be equal to the present value times the growth rate. Of course, future value or terminal value used interchangeably. So this is how we got to this point. The present value at today's money is the terminal value or the future value over the growth rate. Now, why is this important? Why is it important for us to know the present value of something? Because for many reasons. Because let's say I know I need to invest or to, let's say, pay college fees for my children in 20 years' time. I need to buy a house in 10 years' time. There is a certain liability that I'm going to get in the future. I have to pay it. And I need to invest now so that my money will grow and then pay that liability in the future. This is one of the things that we call asset liability matching or asset liability management. I know a certain liability is coming in the future. I have to pay that. I know it's valued at $50,000, but I need to invest today. So this money can grow and become $50,000 in the future. I know the future value. I need the present value of that. So the present value of that equals to the future value over the growth rate. So let's look at this one. Calculate the present value of 20,000 pounds to be paid in 5 years. So I know I have a certain liability to pay in 5 years, 20,000 pounds. And the rate, the interest rate, the discount rate, or whatever that amount is 4%. So the present value, how much should I invest today, is equals to the future value, which is 20,000 pounds, over 1 plus the rate, which is 4%, in 5 years' time. This will give us 20,000 over 1.04 to the power 5 over 1.2166. So 20,000 divided by 1.2166. So this tells me that the present value of that money is 16,439. So if, sure. Yeah, I mean, yes. Now, if you're multiplying, you are growing it. This is now called the growth rate. If you're dividing it, it's now called the discount rate because you are discounting that value. But in the end, it's what you are using. If you're using multiplication, it's called the growth rate. If you're dividing it, it's now called the discount. You are discounting it because the $20,000 in the future, in 5 years' time, is now $16,000. So you have to invest $16,000 today to grow to $20,000. You have discounted the $20,000 into 16. So we now call it the discount rate, 4%. But I mean, sometimes you can even call this rate here at sometimes discount rate, interest rate, whatever it is. But for me, we call it the growth. The whole thing is growth. The rate, discount rate, interest rate, whatever that is. You're not going to be questioned on these small technicalities in this exam. This is not the qualification for it. But interchangeably, if you hear the word growth rate, that means CISI is expecting you to grow it. If you hear the discount rate, CISI is expecting you to discount it. But no problem, Sarah. So if I invest $16,000 today and it grows by 4% every year, in 5 years' time, it's going to become 20,000. Or, in another way, if I am going to receive $20,000, think of it in a different way. If you are going to receive $20,000 or pounds in 5 years, and somebody asks you, how much are you making out of this investment? You shouldn't say, I am making 20,000, because that 20,000 is going to come in 5 years. And we know money today is different than money in 5 years. So if somebody asks you how much you're actually making, considering the effect of inflation and discount rates, you're going to say, well, even though I'm making 20,000 pounds in 5 years, technically in today's value, This is actually 16,000. Considering that at every year that passes, this £20,000 is losing a bit of its value. So these are two different ways for you to look at present value. Either how much should you invest today so that it grows and you get to £20,000, or if you are receiving £20,000 in 5 years' time, looking at it from today's point of view, how much is that actually valued at? The £20,000 in today's value is actually valued at £16,000. Certain investments are gonna bring you multiple payments in the future, like bonds. They give you coupons every year, and then on redemption, you get on that year, you'll get the coupon and the nominal value, both of them. So certain investments, for example, let's say a 3-year coupon, if I'm going to get the price or the present value of it, because bonds, usually they're priced at their present value of their cash flows, for that bond, the price, I'm just giving an example, we'll go into more details later, is equals to the cash flow I get in the first year, the coupon, over 1 plus the rate in the first year, the discount rate. We'll get into these different discount interest rates when we get into that chapter. And in the second year, again, you're going to get cash flows in that second year over 1 plus the rate, 2, because you're now discounting it further. Inflation or discount or interest rates have a compounding effect on money. So every year that passes, money loses more and more of its value. And then in the third year, you look at the cash flow of that third year over 1 plus the rate to the power 3. Now the cash flow in the third year, in the case of bonds, is going to be the coupon plus the nominal value when the bond is redeemed. But we'll get into that later. So what this is saying is that the price of this investment is the sum of all of its cash flows across the years over the over the rate, over the discount rate. Let's look at, I think this was just repeated. Okay. Let's look at an example of a bond. Now we're going to be thinking of rates, discount growth, principal value, and so forth. Let's say a certain bond has a face value or principal or a nominal value or a par value of £1,000. This is the amount you're gonna get in the future. When the issuer takes the bond from you, they are going to give you £1,000. This is a bond which, how many years here? So 1, 2, 3, 4, 5, 6 years. We are going to invest in it in 6 years. For the period of the 6 years, the bond is going to give you, you are going to earn 10% every year. This is the return, the coupon of the bond. But also, the discount rate, which is the value of the bond which you are losing every year, is, in this example, 10%. The discount rate can be anything, whatever the investor chooses. It can be inflation rates, it can be interest rates in the country, it can be, here they consider it the rate of return, which is the expected return for the bond. In certain cases, it can be the yield to maturity, for example, or what we call in British qualifications the gross redemption yield. We are not going to get fixated on what rate we are going to be using as the discount rate. In this case, we're only going to call them discount rate. Now, since you are earning every year 10%, so the value of your investment grows by 10%, and at the same time, the discount rate for that investment is 10%, it's affected by certain investment or certain expectations, which reduce its value by 10%, technically, the value of this investment at the end of the period is going to remain at £1,000. because it is both growing and being discounted at the same rate. So you will buy the bond at £1,000. This is what this concept is telling you here. When the coupon, which is what you earn, and the discount rate, which is what you lose, are the same, the value of the bond remains the same. So you buy it at its nominal, £1,000. In some cases, it's going to be £100. In this exam, if CISI doesn't mention in the question the nominal value, usually they do, assume that the nominal value is 100. Here, they mention that the nominal or the face or the par value is 1,000. So we just assume that it's 1,000. So notice here, the cash flow in the first year is £100 divided by 1 plus the discount rate to the power 1. Cash flow in the second year over 1 plus the discount rate to the power 2 to the power 3 to the power 4. And then this is in the this has 5 years, not 6 years. So this is in the fifth year. He is going to be earning £100 in coupon like the previous years, and he's going to get his nominal back. Now keep in mind, you could have just put 1,100 over the 1 plus the discount rate, number of years. It's the same thing in the end. This tells you that roughly the price of the bond is £1,000 because this is the expected value of the future cash flows. For many investments, for many projects, the expected value of the price of that or the value of that investment is the sum of the expected cash flows. Is the present value of the sum of the expected cash flows. So if somebody tells me, well, no, this bond, some people might say this bond is going to give me £1,000 plus 100 plus 100 plus 100 plus 100 plus 100. So that's £1,500, which is the nominal, which I'm going to get, plus £500. So someone might say, well, I'm going to get £1,500 in cash from this investment. Why are you telling me that the price should be 1,000? Well, you're going to get £1,500 in cash, but this money is in the future. And we know that money in the future is valued less than today. Every year, this investment is losing 10% of its value. So technically speaking, this 1,500 across 5 years is the same thing as the 1,000 today. You'll go more into this if you go into other qualifications from CISI, like the CME4, the ICWIM, when you start to plan for your retirement. So let's say I need every year $100,000. Now, in 2021, I need $100,000 every year to cover my expenses. So I have to find a job that pays me $100,000 every year. Let's assume I'm going to retire in 2050. In almost 30 years' time. How much will I need every year? So let's assume that inflation is 3%. I'm not going to do any calculation. So let's assume I'm going to need $250,000. Does that mean that when I retire in 2050, I'm going to need more money that I need today? No. This $250,000 is the same amount. I'm just giving rough estimates here. This $250,000 is the same amount as $100,000 today. Because in 2050, when I retire, if I decide to live in the same house, eat the same food, drink the same water, drive the same car, have the same lifestyle as I am today, in 2050, I'm going to need $250,000. Again, I'm not having anything additional. It's the same lifestyle. But it's just that money loses value every year. So you're going to need more of it, to cover your expenses. So when the growth and the discount are the same, the value of the bond will be equal to the nominal. But that's rarely the case. In many cases, the growth rate or the discount rate, one of them will be higher. So in this case, let's assume in the second scenario, the company pays actually a coupon of 8%, not 10%, like in the previous case. So your money is earning 8% every year. And the investor's discount rate, the rate of return, we'll cover this rate of return more on the capital structure chapter when we look at the cost of equity and cost of debt. The discount is 10%. So now you see that my money is earning 8, but it's losing 10% of its value. Should I buy this bond at £1,000? No. Because it earns less than it loses value. So technically, the right value of this bond is 924. This makes sense. And the opposite is true. If the bond actually earns, let's say, 12%, and the discount rate, which is the rate at which it loses value every year, let's say it's 10%, then I can probably buy this bond at 1,120, rough numbers. Why am I buying it above nominal? Because it grows more than it loses value. And the opposite is true in this case study. It earns less, it grows less than what it loses value, so I'm going to buy it less than its nominal. And again, we use the same method of calculation. So, the net present value, a way of valuing projects and investments before entering into them. The net present value is equals to the present value of the inflows, how much that investment is going to get me, minus the present value of the outflows, how much I'm going to invest in order to get it. If the net present value is over 0, why would it be more than 0? Because the net inflows, let's say, are 90. The net outflows are 82. So the net present value is a positive 8. So if the net present value is over 0, that means I'm going to get value in this project, in this investment. I'm going to go ahead with it. Of course, the opposite is true. If the present value of the inflows is 80 and the present value of the outflows is 82, then the net present value of this investment is -2. I should avoid this project or this investment. It's because I'm going to end up losing value. For mutually exclusive projects, two projects which are not connected in any way and they do not influence each other, I will choose the project with the highest net present value. In this case, this one, 8. But that's not the case. In reality, but not in this qualification, certain investments might be connected. So there are some certain cases when I might accept this -2. I'll actually go into this project which loses money for me. That's because it provides value in something else. It might get me better customer satisfaction, a better reputation. It might support other products. It might support other services. It might be of help in other departments. In some cases, you might actually accept projects that have a negative net present value, but it's not in this qualification, not in this level. In this level, you only accept investments which have a positive value, especially if they are not connected, if they are mutually exclusive. They have nothing to do with each other. Net present value is the cash outflow. Again, in this qualification, we expect there is one cash outflow at the beginning. This is what you invest. I'm going to invest in a certain company. There's a small company. I'm going to invest in it, let's say $1 million. So $1 million is going to come out of my pocket. I'm going to lose that at the outset. And then this is going to give me inflows. Expected that this investment is going to give me cash inflows for the next few years. Remember, any cash I expect to come in, I have to discount it. I have to remove the effect of the discount on it, which is 1 plus R over N. In reality, sometimes you might actually also need to have some outflow sometime during the investment, and then it's going to continue giving you inflows. That's the case for, let's say, private equity, for example. So you might have an outflow at the beginning, You might have another outflow. They might come back and say, we need some more cash. In this qualification, I doubt in the exam CISI will get into this. But in the same way, if there are 2 outflows or 3 outflows, an outflow is just like an inflow, you have to divide it by, you have to discount it. But don't go into these details a lot in this qualification. So the net present value is the sum, considering the negative cash that I'm going to pay, plus the sum of all of the inflows I'm going to get from these investments discounted. Here, N is usually in years. We've seen cases where the N is in a quarterly or semi-annually. In this qualification, again, this is just an it's a beginner. It's a technical foundation into corporate finance. So you're not expected to look into inflows on a quarterly or a monthly basis. Let's look at a quick example on how this works. A company is considering undertaking an investment project that will require it to spend, so this is negative, that's a cash outflow, spend £75,000 this year, and which in return it expects to generate revenues of £20,000 in the first year and the same amount in years 2, 3, 4, and 5. So they're going to get £20,000 every year for the next 5 years. The discount rate it uses is 10%. So this year, £75,000 is going to come out of their money, of their pocket. And then for the next 5 years, this investment is going to generate £20,000 every year. We have to discount that by 10%. So it's the cash over 1 plus 10%. And if this is in the first year, power 1, second year, power 2, 3, 4, and so forth. So we will notice that the £20,000 actually in the first year is worth £18,000. Second year, 16. Discount rate influences money on a compounding basis for every year. So I'm going to invest £75,000. This is what's coming out of my pocket. And I'm going to get, let's just add all of these cash inflows together. So the 18,000, 181.82 plus 16,528.93 plus 15,026.3 plus 13,660.27 plus 12,418.43. This is going to give me cash inflows of 75,815.75. Actually, it's going to get me cash inflows of £20,000 for 5 years. £20,000 for 5 years, that's £100,000. That's the cash, physical cash I'm going to get. But considering it in today's money, the effect of the discount, it's actually valued today at $75,815. So this is going to get me a positive net present value of 815.75. So I should go ahead, assuming that there is no other project competing for it, for my resources, because in business you have limited capital. And there will be multiple projects, multiple ideas that you're going to get into. All of these are going to compete for your attention and money. Assuming that there is no other investment competing for capital, this is the project that you should go into because it's going to get you a positive net present value at the end. Now, assuming that my discount rate is lower, remember, in this example, the discount rate is 10%. The discount rate can be the expected returns from the investors, for example. It can be, if it's a certain debt, it can be the cost of debt, anything that reduces the value of that money. It can be, again, interest rate, it can be inflation rates. Different projects, different investments, different investment managers use different discount rates. When the discount rate was 10%, the net present value of this investment was 815. However, if the discount rate, let's say, is 8%, not 10%, like in the previous case, so this amount, this cash flows I get every year, they're now losing 8% of their value every year. They're no longer losing 10% of their value. So the £20,000 in the first year is going to be valued at 18,000. In the second year, 17. So the value of these cash flows, I'm still going to lose £75,000 at the very beginning, but I'm going to gain in total. Let me just calculate this quickly. 18,518.58 plus, some of you would say, well, Kareem, just add this £4,000 to the 75. I know it's that simple, but we still want to calculate it to see whether CISI and the book have added it correctly. 18,518.52, and yes, sometimes there can be mistakes. Always assume that. So 18,518.52 plus 17,146.78 plus 15,876.64 plus 14,700.6 plus 13,611.66. So all in all, I'm going to get 79,854.20, which is again £100,000, but discounted at 8%, not 10% like in the previous case. So the present value of this investment is actually 4,854.20. You see how much has jumped? In the previous case, when the discount rate was 10%, the present value of that investment was 815. When the discount rate was 8%, the present value of that investment is 4,854. So because money is losing value less at a lesser rate, this project is now valued more. If these were two different projects, so let's assume this is project A and this is project B. Of course, that's not the assumption in this case. But if these are two completely separate projects, then I would definitely be going ahead with this one because this investment, project B, will be ranked higher. It's going to get me a higher net present value. Before we head into the internal rate of return, let's just look at one more example here so that we can introduce the concept of the internal rate of return. Let me just clear the screen quickly. Let's assume that the discount rate is actually 11%. I want to do the calculation based on this. So if the discount rate is 11%, the cash outflow the first year is going to be the same. The $20,000 cash inflow in the first year is going to be discounted by 11% instead of 10. So that's 20,000 divided by 1.11. So that's going to give us a cash inflow of 18,018. And then in the next year, we have to put it to the power 2. So that's going to give us a cash inflow of 16,232. Plus in the third year, that's going to give us 14,623. In the fourth year, the cash inflow is going to be 13,174. And in the fifth year, it's going to be 11,869. So we're going to have to pay out $75,000. And the return we're going to get, let's just do this quickly, 18,018 plus 16,232 plus 14,623 plus 13,174 plus 11,869. So we're going to get cash flows valued at 73,916. So what we'll notice here is the value of our cash outflow is less than what we are going to get. So we're going to pay out less than what we're going to be getting. That means we will be losing $1,084 because that's the net present value of this investment. If the discount rate is 11%, we will lose $1,000. The net present value will be negative. If the discount rate is 10% and below, it's going to be 815. Keeping this concept in mind, I'm just going to write these down. So at a discount rate of 10%, our net present value is 815. And at 11%, our net present value is 1084. Let's get into the internal rate of return. The internal rate of return is the rate right here. In the previous examples, we already have the rate. In this case, it was 8%. In the other case, it was 10. In this case, it was 11%. We already know the rate. And we use it to the calculation. The internal rate of return, we don't know the rate. It's actually the rate that we have to calculate. So the rate is unknown. We need to find out that rate. We need to find out the rate at which the net present value will be 0. That means the rate at which the cash outflows, which in this case, let's say, in our case, in the very beginning, it was 75,000, yes. So the cash outflows will be equal to the cash inflows. Thereby, the net present value of this investment becomes 0. So, going back to this example, at what rate, the rate here, what is the number where this total amount here becomes 0? If we go back to our previous page, we know that at 10%, the net present value is 815. At 11%, the net present value is at negative 1,000. So somewhere in here in the middle, the net present value can be 0. So it has to be somewhere in the middle between 10% and 11%. Just going to repeat it quickly. At 10% discount rate, this project is valued, the net present value is positive 815. At a discount rate of 11%, we'll be losing more value in this investment. So the net present value will be negative 1,000. So somewhere between positive 815 and negative 1,084, the net present value can be 0. So the discount rate will be somewhere between 10% and 11%. And this is the problem with the internal rate of return. The rate at which the net present value is 0. The problem with it is you will have to guess. Trial and error. You'll have to, in the exam, you'll have to say, okay, let me try. Usually, we recommend you start somewhere between 5 and 10%. And I'm going to give you probably a sample question at the end of today and show you how to answer it. So you will start between two similar ranges. So you can never be, let's say, start at 30% or 50%. It's not going to be that sort of questions. Once you see the list of choices that you have, you will take two of these two numbers, and then you will find the number in the middle. But since you are allowed in Saudi Arabia to take a financial calculator with you into the exam, then you can just use the financial calculator. It will give you the internal rate of return quickly. And this is the good thing with allowing you to, and it also gives you the net present value quickly. In here, we had to calculate for every year. But if you use the financial calculator, it will just give it to you instantly. It will also give you the internal rate of return instantly. You'll have to watch videos on YouTube on how to use the net present value and the internal rate of return on your calculator. So, going back, keeping this in mind, if we use a discount rate at 10%, we get a positive net present value, 815. If we use a discount rate of 11%, we get a negative net present value. So at what rate, somewhere in the middle here, at what rate will we get a 0 net present value? This is the internal rate of return. The discount rate where the net present value becomes 0. If that rate is higher than the required rate of return, then we accept the project. If that rate is less than the required rate of return, we don't accept that project. Let's look at a quick example. So we say here, between 10% and 11%, remember, at 10%, we get a positive 815. At 11%, we get a negative 1084. So you can start saying, okay, You know what? Let me go back to the previous table, and then I want to try a between 10 and 11. Let me try 10.1. And then you would say, let me try 10.2. Let me try 10.3. And then all the way to 10.9 for you to get an NPV of 0. That's going to take a lot of time. So since we have an idea, it's going to be somewhere between 10 and 11, 10 being the lower and 11 being the higher. There is a formula for it. The only accurate way to establish this IRR, again, I'm going to write this here. At 10%, we're going to get a positive 815. And at 11%, we're going to get a negative net present value at 1084, if I'm not mistaken. The only accurate way is through a lengthy process of trial and error. Using a range of discount rates, 10.01, 10.1, 10.2, 10.3, all the way to 10.9, you probably need 6 hours in this exam. And a scientific calculator or a spreadsheet formula. However, an approximate internal rate of return, which you should be fine with in the exam. Remember, this exam, it is assumed that you are not using a scientific calculator and you're not allowed to take one. So you are very likely to get something approximate and you're fine with that. An approximate internal rate of return can be derived through a shortcut methodology known as interpolation. Interpolation takes a lower discount rate that produces a positive NPV and a higher discount rate that results in a negative NPV, which in our case here is 11%, and then finds a rate between them that produces the zero NPV. It will give you this question mark here. The formula for estimating the internal rate of return through interpolation is this: the lower rate plus the NPV at the lower rate over the NPV at the lower rate minus the NPV at the higher rate times the higher rate minus the lower rate. So let's look at this quickly. So if we say here, at the lower rate, which is 10%, I think it's somewhere here written. There you go. I'm going to write this here for you. 10% is our lower rate, and it gives us a positive NPV of 815. And 11% is the higher rate, which discounts our money at the higher rate, so we lose, which gives us 1,082 or 84. So this is the lower rate, and this is the higher rate. Look, if you're allowed to take a financial, by the way, speak with the Financial Academy in Riyadh, confirm with them that you can take a calculator with you. The last time we did this qualification, a few months ago, they said yes, you can. So check with them before you go, please. But if you are allowed to take the calculator, don't bother with memorizing these formula for the IRR. You can just do it in the calculator. Just remember the method in your calculator. So it's the lower rate plus the NPV at the lower rate over the NPV at the lower rate minus the NPV at the higher rate times the higher rate minus the lower rate. And when we do it, we get an internal rate of return of 10.43%. Again, this is an approximate value. Let's go back and see whether using 10.43% will give us an NPV of 0 or close to it. So let's say at an NPV, remember, at an NPV of 10%, at a discount rate of 10%, it gave us 815. At a discount rate of 11%, it gave us 1,082. Let's say at a discount rate of 1043, let's see how much it's going to give us. The cash outflow is going to be the same. Let's just do the calculations quickly. So 18,018 divided by 1.8 1043. So in the first year, I got this one wrong. It's 20,000, not 18. Sorry. So this is going to give me a positive 18,111. In the second year, it's going to give me a positive 16,400. The third year is going to give me a positive 14,851. In the fourth year, 13,448. In the fifth year, 12,178. So let's add all of these together. Let's see how much the total inflow is. 18,111 plus 16,400 plus 14,851 plus 13,448 plus 12,178. So we get a total inflow of plus 74,988. So if we do this calculation, we're going to get a negative 12. Very close to zero. So probably the rate is going to be somewhere around, probably, I would say around 10.3. But then again, in the exam, you only need to have an estimate of it. Don't worry much about that. Right. And we ended the chapter with a few concepts. Competing projects, because every business, not just competing projects, competing investments, anything that is requiring you to pay, are usually ranked in ascending order of their respective NPVs, rather than the IRRs. NPV provides a superior means of ranking. The IRR should be used as a way of establishing a break-even rate, because at the IRR, the rate where the cash inflows equals to the cash outflows. So the IRR is sort of the rate which is your cost. The rate of return should be higher than the IRR. That means you're getting more than your cost. If your IRR is 10.4, this investment should get you more than 10.4. So you can make yourself a profit. If it's expected to get you less than 10.4, you're going to end up losing. Why? Because 10.4 is your cost. 10.4 is the rate at which your inflows and your outflows are equal. Thereby, you are at break even. Sometimes we call it the cost rate. Sometimes we call it the hurdle. Hurdle rate is something that you usually hear like in hedge funds. Hurdle rate is something that you have to cover. It's something that you have to overcome. It's something that you have to have something higher. It's something that is sort of a cost, something that is holding you back. Setting a hurdle rate for evaluating projects. So any project that has a higher rate of return than the IRR will be accepted. When using the discounted cash flow techniques, like we just covered here, considerations should be made regarding forecasting errors. That's the biggest sort of the complaint or the biggest criticisms of the IRR and the NPV. It's like saying, okay, look, these cash inflows you are expected, how guaranteed are they to come in? Okay, I know for sure that my initial 75,000 is going to go out because I control that. But the inflows that are going to come in for the next 5 years, how sure are you they're going to come in? There's a chance they might not. Nothing is guaranteed. And not just that. What about the discount rate? We are assuming discount rate of 10%, 11%, 8%. I mean, discount rate can be based on so many different things. All of them are estimates. All of them. And you've noticed when we move from an 8% to a 10%, when the discount rate was 10%, this project was valued at £815. When it was 8%, this project was valued at £4,000, 4,000 something pounds. See the difference? It's only the difference in 2%. So a difference of 1%, let's say at 9%, you probably get a valuation around, let's say, £2,000 or something. These are big differences. And when you're looking at millions of dollars, as in the case of many investments, that's a big difference. initial investment, subsequent cost, anticipated revenues. You can make mistakes in forecasting these. Inflation, cash flows in real terms discounted by a real discount rate. Project risk. Acceptance of a project can increase or reduce the risk attached to a company's existing operations. Let's say you are expected to invest in this company. There might be not just cash. Cash is one thing in any investment, but there are multiple types of risk involved with it, with most businesses and most investments. And the discounted cash flows, the NPVs and the IRRs, they don't consider anything else besides cash. Cash and the discount rate. So these are certain, definitely, criticisms that you have to keep in mind when you are considering using these discounted cash flow techniques.